Well, Mark Matthews of Bank Julius Baer and Company is now joining us to take some questions. Mark, good to have you with us here. Thank you very much for your time. The 10-year is about 4.4% in the U.S. now. Would you say that, by the time the cycle is over, market interest rates will get up to where the Fed funds rate is at or will be at eventually, where the peak is? So if that's the case, we perhaps have got some more to go, some distance more to go. What's your sense?
My sense is if that happened, it would be a first in history. And the reason I say that is this relentless rise in the bond yield, of course, means that the bond price has been falling. And if 15 weeks from now, the 10-year Treasury is still yielding 4.33%, where it is now, then we will clock in a negative return for 10-year Treasuries in 2023, which I'm sure you know will mean it will be the third year in a row of negative returns. And for the U.S. government bond yield, we have data going back, believe it or not, 233 years to the year 1790. That has never happened before. So if the bond yield is going to go up to match the Fed funds rate, we're definitely going to get that 3 years in a row. And I just don't think we should. I think that, firstly, the oil price, the big rise in the oil price has not been accompanied by other commodities. And when we study similar patterns in the past where you had a big rise in oil, but the rest of the complex has been flat or down, the oil rise is unsustainable. And we feel that the Saudi production cuts, which are the reason for the big rise in oil, are going to be more than made up for by the pariah states like Russia, Venezuela, and Iran. Property prices are falling because mortgage rates are high. And then if you look at the employment cost index, which is the Fed's favorite measure of compensation, it has been falling. That, by the way, was the reason they got hawkish back in late 2021 when it was rising very quickly. And it tends to follow the labor market's quit rate very nicely, and the quit rate has been falling pretty fast. So I put it all together. I think inflation's coming down, maybe not to 2%, but it's going to go back down lower than where it is now. And I don't see the need for the Fed to raise rates anymore, and therefore don't really think that bond yields should go higher than where they are now. But I must confess that they have been contradicting everything we've been saying, because people didn't think they would go higher, and they have kept going higher.
All right, so you're saying that in this Fed policy, you don't see the need for the Fed to raise rates. Got it. But what about the dot plot? What is the expectation as far as rate cuts are concerned? Do you expect to hear anything of that sort in this meeting? If yes, how should, risky assets like equities look into that?
Well, I have read what you just said, that and I don't know where anybody's getting this, whether there's some kind of leak in the Fed that's purposely letting us know that they might be, increasing their forecasts for inflation and GDP growth and commensurately reducing the number of cuts that those participating officials are forecasting. But I don't mean to be mean, but the dot plot doesn't have a very good track record. So just because they say that, it doesn't mean it'll actually happen.
Hi, Mark. Good morning. You've been quite bullish on the Indian markets, but with, the dollar index at around 105.5, you have Brent at around $94 per barrel, which, as you said, it's not sustainable. How do you approach the Indian markets, from here on?
Well, number one, I think technically they are breaking out. Number two, the benchmark for the world is the S&P, and it has had something like a 90% correlation to its seasonal average since World War II. And we all know the best time to be in the S&P is the end of the year. So I suspect that this consolidation that we're in now will be over by mid-October, and we will get a year-end rally for the S&P. And if we do, the Nifty can catch a ride on that. And then I'll just say, I don't think I'm revealing anything confidential, that we've noticed a big pickup in interest in India on behalf of our clients. I can't say I've seen that in 20 years. And why is it? I don't know. Maybe it's people throwing in the towel on China. Maybe they're just realizing that it is a good story, and they're willing to contemplate it now, whereas they weren't before. But I feel it is a good story. I feel that, with the NPAs down to very low levels, banks are lending again. There's a need for loans. The corporate sector is doing well, and that should translate into earnings growth in the high teens. Therefore, I don't see why it won't continue to go up.
Okay, all right. We'll leave it at that, Mark. Thanks a lot for joining in and giving us your thoughts. And have a great week ahead.